In the last video, we said something that sounds simple but becomes extremely difficult when markets fall. Emotional control matters more than performance. And we ended with this. In the next video, we'll go deeper into what emotional control looks like during real market stress. Not theory, not motivation, but how long-term investors stay calm when markets fall, headlines turn negative, and fear feels justified. So, let's begin there. Bogle, Munger, Lynch, different careers, different tools, different philosophies, and yet over decades, they converged on the same behavioral principle: don't interfere. That sounds easy until the market drops 30%. Let me ask you something uncomfortable. If your portfolio fell 35% over the next 12 months, would you actually do nothing? Not theoretically. Actually, would you watch $100,000 turn into $65,000 and stay invested? Because that scenario is not rare. It happened in 2000, 2008, 2020. And here's what most investors misunderstand. The majority of long-term wealth is built in the years immediately following those declines. But most people don't participate fully in those recoveries. Not because they panic, because they hesitate. They reduce exposure temporarily. They pause contributions. They wait for clarity. And those small, reasonable decisions compound into massive long-term differences. This video is about that moment. The moment when fear feels justified. Because during market stress, discipline doesn't feel like discipline. It feels like risky. By the end of this video, you will understand the statistical structure of crashes. Why do recoveries begin before confidence returns? The compounding math of hesitation. The neuroscience of market stress. And what long-term investors structurally do differently. Let's begin with the structure of market declines. This video is for educational purposes only. Nothing here is personalized financial advice. All historical data referenced comes from S&P Dow Jones Indices historical total return data, Federal Reserve economic releases, National Bureau of Economic Research, NBER, recession records, J.P. Morgan Asset Management long-term capital market studies, Dalbar investor behavior studies, historical U.S. equity market data dating back to 1926. Past performance does not guarantee future results. Markets can decline significantly. Volatility is normal. Always evaluate decisions within your own financial framework and timeline. Since 1926, U.S. equities have returned approximately 10% nominal annually, 6 to 7% real after inflation. But averages conceal dispersion. That 10% annual return has never arrived smoothly. Let's break this down more precisely. From 1926 to 2023, roughly 70% of calendar years have been positive. About 30% have been negative. About 12% to 15% of years have seen declines greater than 15%. Approximately every 5 to 6 years, markets experience a 20% plus drawdown. Bear markets are not rare anomalies. They are recurring statistical events. Now look at rolling periods. Since 1926 to 1-year returns are highly volatile. 5-year rolling returns smoothly. 10-year rolling returns have historically been positive the vast majority of the time. 20-year rolling periods have historically produced positive returns in nearly all measured instances. The longer the horizon, the tighter the distribution. Short-term returns are chaotic. Long-term returns are structurally upward. This is the fundamental tension of equity investing: short-term randomness, long-term persistence. The average bear market decline has been roughly 30 to 35%. That means a 30% drop is not extreme. It is typical. If you plan to invest for 30 to 40 years, you should expect to experience multiple 30% declines. Not as a possibility, as a statistical likelihood. Most investors intellectually accept volatility, but emotionally interpret each decline as abnormal. That mismatch drives interference, and interference erodes return. From October 2007 to March 2009, S&P 500 declined 56.8%. The financial sector collapsed more than 80%. Housing prices fell nationally for the first time in modern U.S. history. Global credit markets froze. Major institutions failed. Lehman Brothers collapsed. AIG required emergency support. Bear Stearns was acquired under distress. Money market funds broke the buck. This was not a typical recession. It was a systemic financial crisis. For investors at the time, the fear was not simply that markets would fall further. The fear was that the system itself might not recover. Unemployment peaked at 10%. GDP contracted sharply. Consumer confidence collapsed, and yet the market bottomed on March 9, 2009. At that moment, economic data was still deteriorating. Foreclosures were rising, headlines were deeply negative, confidence was near historic lows. From March 2009 to March 2010, the S&P returned approximately plus 68%. Why? Because markets' price expectations. By early 2009, expectations had collapsed to extremes. Prices overshot relative to long-term earnings capacity. Markets began recovering before confidence returned. Temporary exits during that environment often became permanent performance gaps. The scariest environments often precede the strongest forward returns, because price adjusts faster than emotion. Dalbar research shows the average equity investor underperforms the market by approximately 2 to 4% per year due to behavioral timing. Over long periods, that gap compounds dramatically. If $250,000 compounds at 10% for 35 years, $7.03 million. If it compounds at 7%, $2.67 million. The difference is $4.36 million. Most investors do not lose wealth because of one catastrophic panic. They lose wealth because of repeated small interferences. Small emotional decisions, repeated over decades, compounding silently. J.P. Morgan data from 2002 to 2022 shows fully invested $10,000, approximately $61,685. Miss the 10 best days, approximately $28,260. Miss the 20 best days, approximately $16,180. 7 of the 10 best days occurred within 15 days of the worst days. Volatility clusters. Markets operate in volatility regimes. During low volatility regimes, price movements are smaller. Headlines are calmer. Emotional stress is lower. During high volatility regimes, price swings are large. Headlines are intense. Emotional pressure increases dramatically. The largest positive days in market history disproportionately occur during high volatility periods. This means the strongest rebounds happen when fear is elevated. If you exit during stress, you must choose when to re-enter. What signal do you use? GDP improvement? Unemployment decline? Earnings recovery? Positive media tone? Historically, by the time those improve meaningfully, markets have already advanced. Re-entry is psychologically harder than exit. Participation captures clustered rebounds automatically. Timing requires emotional precision during periods when emotional precision is least available. Losses feel roughly twice as powerful as gains feel good. Under stress, cortisol levels rise. The amygdala activates. Prefrontal decision-making weakens. You prioritize certainty over probability. Selling reduces anxiety immediately. Relief reinforces behavior. Short-term emotional reward. Long-term financial cost. Discipline must rely on structure, not motivation. February 19 to March 23, 2020. The S&P declined 33.9% in just 23 trading days. Unemployment surged to 14.7%. The global economy shut down. Airlines grounded. Businesses closed. Economic uncertainty spiked. Yet the market bottomed out on March 23, before vaccines, before reopening, before employment recovery. From March 23 to June 8, plus 45% in 11 weeks. Markets discount expected future cash flows. Since 1950, after 30% plus drawdowns, forward one-year returns have historically exceeded long-term averages. Lower prices increase expected return. Fear peaks when expected return improves. That inversion drives hesitation. Let's slow this down and model it properly. Assume a $500,000 portfolio. The market declines 30%. Portfolio drops to $350,000. That decline feels large, but it is statistically normal. Now imagine the investor reacts not with full panic but partial interference. They sell 30% of the portfolio, temporarily. That's $105,000 moved to cash. The market rebounds 50% from the bottom. The fully invested portion recovers. The cash portion does not. The gap created in that single rebound is approximately $52,500. That number doesn't look catastrophic, but compounding magnifies small gaps. Let's compound that $52,500 at 8% annually for 25 years. Future value is $359,500. One partial emotional decision, nearly $250,000 in long-term impact. Now zoom out further. Assume a 30-year investing horizon. Historically, over 30 years, an investor should expect multiple 10 to 15% corrections, at least 2 to 3 bear markets, potentially one severe 40% plus drawdown. Now assume the investor repeats the same behavior, not panic, not full exit, just temporary reduction. If each major cycle creates a $50,000 to $75,000 recovery gap, and each gap compounds forward independently, the cumulative opportunity cost can approach or exceed 7 figures. And this is before considering contribution behavior. Now add contribution interruption. Assume the investor contributes $1,000 per month. During downturns, they pause contributions for 18 months because it feels uncertain. That's $18,000 not invested at discounted prices. Historically, returns following 30% plus drawdowns have exceeded long-term averages. If that $18,000 had doubled over the next cycle, which is not uncommon over a decade, that's $36,000 plus in missed compounded growth. And that's one interruption. Repeat that pattern twice across a 30-year horizon. The damage compounds again. Now layer in taxes. If the partial sale triggered capital gains realization, immediate tax drag reduces reinvest-able capital. Future compounding occurs on a smaller base. Even disciplined re-entry doesn't fully repair the lost tax efficiency. Compounding works best when uninterrupted. Interference introduces timing risk, tax drag, cash drag, psychological hesitation, re-entry friction. And here's the critical point. Most investors don't sabotage compounding with dramatic decisions. They sabotage it with reasonable ones. Reducing exposure, waiting for confirmation, pausing contributions, rebalancing emotionally rather than structurally. Each action feels prudent. Each action slightly resets compounding. Now consider sequence of return sensitivity. Early cycle missed recoveries mattered disproportionately. Missing strong returns early in a recovery reduces the capital base that compounds for decades. The market does not punish being wrong once. It punishes repeated interference. And repeated interference often hides behind caution. Compounding is not just about earning 10%. It is about preserving uninterrupted exposure to that 10%. Mathematically, the biggest advantage long-term investors have is not brilliance. It is continuity. Continuity compounds. Interruption multiplies cost. The real risk during downturns is not volatility. It is behavioral interference with compounding mathematics. Now let's examine a different kind of stress test. Not a fast collapse, not a violent panic, but a slow grind. The dot-com crash. From March 2000 to October 2002, the S&P 500 declined approximately 49%. The Nasdaq declined approximately 78%. Thousands of technology companies disappeared. Household investor confidence collapsed. But what made this period uniquely difficult was not just the decline. It was the duration. In 2000, the Shiller-Cape ratio exceeded 40, one of the highest valuations ever recorded in U.S. equity history. Expected forward returns were structurally lower. This was not simply panic. It was a valuation reset. Now look at recovery timelines. The S&P 500 took roughly 7 years to fully recover to its prior peak. The Nasdaq took approximately 15 years to reclaim its 2000 high. 15 years. That is not a crash. That is an emotional endurance test. Fast crashes test fear tolerance. Long stagnations test patience. During 2000 to 2002, investors experienced repeated false rallies, multiple 15 to 20% temporary recoveries, continued negative earnings revisions, corporate scandals, Enron, WorldCom, a recession beginning in 2001. The psychological damage was cumulative. Now here's where behavioral erosion becomes subtle. Investors don't necessarily panic in year 1. They lose conviction in year 3. They begin questioning in year 5. They say, maybe equities just don't work anymore. Maybe this is a lost decade. Maybe I should reallocate permanently. That's fatigue. Fatigue is more dangerous than fear. Fear is sharp. Fatigue is slow. And fatigue often leads to structural allocation changes. Now look at long-term data. From 2000 to 2009, the S&P 500's annualized return was approximately 0%. The so-called lost decade. But from 2010 to 2019, the S&P 500 returned approximately 13 to 14% annually. Those who exited late in the stagnation missed the strongest compounding phase. Now let's model this. Assume a $400,000 portfolio in 2000. The portfolio declines 40 to 50%. It stagnates for years. The investor reallocates to bonds permanently in 2005. From 2005 to 2019, bonds returned approximately 4 to 5% annually. Equities returned double-digit annualized returns post-2009. Over a 15 to 20-year window, that allocation shift could create hundreds of thousands of dollars in divergence. And again, the decision felt rational. After years of stagnation, reallocating feels prudent. But long-term investing requires tolerance for temporary overvaluation resets, multi-year stagnation, narrative shifts, sector rotation, structural regime changes. The dot-com crash teaches a different lesson than 2008 or 2020. It teaches, even when returns are flat for years, compounding is not broken. It is delayed. Valuation resets compress future returns. They do not eliminate them. Now consider rolling 20-year periods. Historically, 20-year rolling returns for diversified U.S. equities have been positive in nearly all measured periods. That includes periods starting before the Great Depression, before World War II, before the 1970s inflation crisis, before the dot-com bubble. Long stagnations are uncomfortable, but they are not permanent. What destroys compounding is not stagnation. It is permanent exit during stagnation. This is why participation dominates timing. Because timing requires correct exit, correct duration, correct re-entry. 3 decisions. Participation requires staying invested. 1 decision. The dot-com crash was not just a market event, it was a psychological marathon. And most investors underestimate how exhausting stagnation can be. Fear causes selling, fatigue causes quitting. Both interrupt compounding, and long-term investing demands tolerance for both. If your portfolio fell 40% over 2 years, would you continue investing? Comment below. Have you reduced exposure during a downturn? What happened next? If you value investing grounded in data, behavioral reality, and long-term structure, subscribe. This channel isn't for traders. It isn't for hype. It's for investors who want to think clearly when others can't. If that's the investor you're becoming, stay with us. In the next video, we'll build the pre-commitment system that protects you before volatility begins. Since 1926, equities have survived the Great Depression, World War, oil shocks, double-digit inflation, financial crises, pandemics. Every generation believed, at some point, that this time is different. And every time, long-term ownership was rewarded. The average return has been about 10% per year. Not smooth, not predictable, but persistent. The market does not require optimism. It requires endurance. Emotional control is not confidence. It is refusing to let volatility interrupt compounding. Staying calm during a crash is not personality trait. It is preparation. And preparation compounds. But here's the problem. Most investors only try to prepare after volatility begins. By then, emotion is already in control. In the next video, we're going to build the pre-commitment system that protects you before the next crash happens. Automatic rules, decision boundaries, behavioral guardrails, so when the market falls 30% again, and it will, your future self doesn't have to be strong, because the system will already be stronger. If you're serious about long-term investing, don't miss that one. I'll see you in the next video.